So please, without further ado, if you could just take a moment and type yes if you can hear me okay. Type yes if you can hear me okay. I always like to make sure that everybody can hear me okay, and then we are good to go. So please type yes if you can hear me okay. Okay, awesome, awesome, awesome. So again, welcome to Home Free USA. My name is Milan Griffin. I'm so happy to have you here. And again, please type yes if you can hear me okay, and that will help me to make sure that we are all on the on the same page. Okay, again, welcome to Home Free USA. You know, when it comes to home ownership and financial preparedness, Home Free USA, please consider us your nonprofit home ownership advisor. We are here to help you to become and to develop your home ownership potential. If you're interested in buying a home, we are here to guide you through the process. Consider us consultants through the process or home ownership advisors. We guide you through helping you to get your credit improved, debt reduced, and your savings in line. And we are here to help you also if you are facing foreclosure, to get the foreclosure prevention relief that you need so that you can find a favorable option that will suit your specific situation. So consider Home Free USA your, I guess, umbrella in any type of financial thunderstorm that you may have. We've been in business since 1995, and since then we've helped over 23,000 people achieve their dream of home ownership with a 0% foreclosure rate. And no matter what you want to do in terms of your home ownership endeavors, it is very important to know that you do have to have your financial picture in line. And even if you're renting and you don't want to buy, or you currently own a home and you are paying your mortgage on time, so many of us are battling with issues with our credit that it is so important that we are in a position that we're in a position whereby you can get the credit help that you need to succeed. So today on our webinar, Amazingly Simple Ways to Boost Your Credit Score, we're going to be talking to one of the experts in the field, and I'll introduce her in a second, about just that, ways that we can really boost our scores and get to the point in which we want to achieve our financial goals. And so as we begin, I do ask, please tell me on the line, do you currently own your home? Just so we can get a picture of who is on the line. Do you currently own your home? Okay, awesome, awesome. So most people are buyers and they do not currently own their home. Excellent. Great. I'm just going to give a couple more seconds. Do you currently own your home? You could put no, yes, and if you don't know, it's totally okay. Awesome. And as we continue to keep things going, are you currently renting? You know, some of those who may not own a home, they may be living rent-free with their parents. They may still be in, you know, who knows? But are you currently renting your home? Yes or no? Okay, awesome, awesome, awesome. And then the next question, are you in the home purchase process? So for those that are not current homeowners, but hey, even if you're a current homeowner, I currently own a home and I'm looking to buy another one. So technically I am in the home purchase process. So let me know, are you in the home buying process? Are you currently in the home buying process? Awesome. Okay. So what's interesting is I see that most people on the line, over 80% of folks on the line, are currently renting. They do not own their home, but only about 56% are saying affirmatively that they are in the home purchase process. So do know, for everyone that is renting, that is currently looking to buy a home, HomeFree USA is here to help you. Just imagine if you were lost in a dark forest and you needed to get out quickly. HomeFree USA is your tour guide. We will guide you through the dark forest of home ownership, because there's so many ways to get lost, so many different trees and cobwebs and pitfalls and everything else. So we are here with the flashlight. We've already taken the tour. We know exactly what you need to get out of that forest so that you can land at your home, and we are guiding you through the home purchase process. We will get back in touch with you later on today, as late as tomorrow, to just talk to you more about how we can help you to do so. The last thing, do you need help to improve your credit? Do you need help to improve your credit? Yes or no? Do you need help to improve your credit? Yes. Okay, now that is the one thing that is 100% everybody agrees with. So today, at Amazingly Simple Ways to Boost Your Credit Score, you will learn just that. You will learn some amazingly simple ways to boost your credit score, and quite frankly, there are a few people on the line that don't need help to boost their credit score, but they just want to learn and want to know how to keep their credit score correct, how to keep it up on the up and up. And that is something you will learn today as well. So I so appreciate everybody joining us. The word home free means safe and out of danger. If you look up the word home free in the dictionary, it means safe and out of danger. Consider us your guide to help you to be safe and out of danger financially. We have advisors here that are experts in the field and that will work with you. We're also connected to partners like Olive, who is with E-Trade, who she is one of the people that we rely on, because we're not experts. I mean, we are experts at the line in which we're the experts in, but we partner with other experts in different areas to really help us to boost our productivity and boost our results with our clients. So welcome. So today's session of Amazingly Simple Ways to Boost Your Credit Score, we will learn what credit is and why it is important. We will learn what credit is and why it is important. We're also going to discover 6 simple ways to boost your credit score. There are many people on the phone. Some of you all may be trying to do it yourself. Some of you all may be working with a credit repair group. Some of you all may be working with HomeFree USA to really build and boost your credit. But whatever the case may be, and whomever you're working with, do know that there are things that you can do on your own to really help to expedite your results. And so we are going to share some of those tips with you today. So Olive Odahan is the Community Development Manager with E-Trade. She is very passionate about the importance of financial education, and she has been a long time and faithful partner of HomeFree USA. That is important because, you know, there are 1,001 different people in the mortgage industry, but when you meet people who are passionate about making sure that consumers like yourselves they have the knowledge that they need to work through, when they are passionate about cultivating and creating knowledgeable consumers who can make the right decisions in the home purchase process, that can make the right decisions financially. When you have a person like that, when you have a professional like that, it says a lot. And when they go out of their way to partner with organizations like HomeFree USA so that we can get the folks knowledgeable, and then the folks we create or cultivate into knowledgeable consumers, they then become better clients for entities like E-Trade. So we thank Olive for working with us. We thank her for her passion in making sure and cultivating informed consumers. So let's, without further ado, welcome Olive. And if Olive, I don't know how to do my hand clap on here, but I will definitely try to find that at some point, do my hand clap for you. So we'll get that in next go around. But Olive, welcome. Talk to us about amazingly simple ways to improve your credit score. So everybody knows, I am going to control the the slides, so you'll hear Olive saying next. I do want you to send me in your questions. Please send me in your questions so that I can ask them as we move through the PowerPoint. Without further ado, let's hear from you, Olive.
Okay, well, thank you, Milan. And it really is a pleasure and an honor to be here. And as Milan said, this is something that I actually love doing. I love sharing the benefits of the mistakes that I've made. And because I also very much believe that the more educated we are, the better consumer, the better we can make decisions about our financial life. So today, as we explore the topic of amazingly simple ways to improve your credit score, I'm here hopefully to plant seeds that will help each one of us grow in our lives. And so again, this is not about E-Trade. This is more about Olive, the individual, just sharing knowledge based on, in terms of credit and credit scores. So the first seed that I would like to plant today is that this issue of improving our credit is 80% behavior and 20% knowledge. So through our conversation today, you're going to hear and learn, and and this is something that I've also learned in my own life, that it doesn't matter how much knowledge I have if I don't actually practice it, as in changing my behavior, my spending behavior, then then it's a waste of time. So that's the first seed, 80% behavior and 20% change. So hopefully the knowledge we'll share today will ultimately help help each one of us make progress. And as Milan says, please also ask questions as we go through. So what will excellent credit do for you? So what I did was, to understand what this really means, I first wanted to understand the definition of credit. So I Googled it. I looked it up in the dictionary, and the definition of credit is that it is the ability of a customer, each one of us, to obtain goods and services before payment is made based on trust that payment will be made in the future. So let me translate that to put that in layman's terms. So the customer, you and I, we go into a store and we want to buy something, or we want a service, and that store says, okay, you can take this without making payment, and because I trust you, I know that you'll make payment in the future. So that is what credit is about. So can we have the next slide, please? So simply put, your credit is your reputation as a borrower, because it will tell how credible an individual you are. So let's break that down. So you have, each one of us, so we as a group, we have two very close friends. So there's friend A and friend B. Now both friends have asked to borrow $500 each. Now each of them has explained that they need this money to fix their car, to be able to get to work. So this is something that I'm sure everybody on this call can understand. Because we understand the seriousness, we understand the importance of having a car that will get us to work, and because these are our friends. So we agree to give friend A and friend B the $500 each. But before we do that, we also say to them, you absolutely have to promise to pay this back in 5 months at $100 per month. So we've agreed to it, we've set up an agreement, and then they have committed to pay $100 a month, so we've made the payment easily affordable for them over a 5-year period. So next, we notice that friend A has kept their word, and they make their $100 monthly payment on time, and we don't have to remind them, we don't have to chase after them, we don't have to call them, we don't have to text them. And so by the end of month 5, they have actually honored their commitment and they have completed the payment. But friend B is different. So friend B needs reminding, and in fact, friend B was behind on their payment, and as always, friend B always had an excuse about why they couldn't pay on time. And then next, we have to start calling them, texting them. It's like pulling teeth, and we start getting tired. So in month 5, friend B still has an outstanding balance. And by this time, they're even avoiding us. So I ask, which one of these friends is credible? Which one of these friends would you want to loan money to in the future, or even have any kind of business transaction in the future? So this is a very, layman's example of what credit is. So credit is our key to good financial health, and your credit will impact your ability to rent a nice apartment. It will affect how much you pay for insurance, and it'll even impact one's ability to get a job. So landlords, employers, insurers frequently use credit to make decisions, and they look at it as a measure of seeing if the individuals they're dealing with are reliable and responsible. So another point I'd like to make is that I think everyone on this call knows and understands that the economy of the United States is run on credit. So how good each one of our credit is will determine our access to capital, access to money, the price we pay for every major purchase that we're going to make in our lifetime, which includes a car, a house, a student loan. So credit does affect every area of our lives. Next slide, please. And you know what? Bad credit can cost us. Next slide, please. So I'd like to just go over very quickly some of the impact of bad credit and what bad credit can do, and it will create everything that's negative in our lives. Bad credit can limit our employment opportunities, and we'll talk a little bit more about this further in the discussion. It can make it harder for us to keep a job, find a job. It definitely will limit our ability to make large purchases, and definitely we will not be able to get the best deal with bad credit. So even just as critical, bad credit can create stress, bad health, and sleepless nights. So why would we want to subject ourselves to this if we can change our behavior, and as a result, as a result of the knowledge that we are going to gain today? Next slide. So the question now is that I ask each and every one of us on the call today, what is the smartest thing you've done for your credit that you've done to date to improve your credit? What is the smartest thing that you've done to improve your credit to date? Next slide.
And please go ahead and just type that in, and then I'll just kind of report back as they come in. What is the smartest thing you all have done to improve your credit so far? Excellent. Okay. So I love what folks are saying. On-time payment is coming up a lot. And you know what? If there's anything you can do, that is definitely an effective one. Another one that our guests are saying, Olive, making the car payments on time, paying the credit card balances in full every 6 months, every month. Excellent. That's awesome. So not letting those balances roll over, limiting the amount of new credit. Look, Olive, I think some people may have already taken this workshop before.
Yes, sounds
paying
like
off
that.
bills. And they contacted, I love this one, Olive, they contacted a credit counselor and researched how to do effective credit disputes. And I love how they went to the counselor side versus the credit repair clinic, and we'll talk more about that. But go ahead, Olive. And they also paying off a few credit cards that are no longer in use, but not closing them.
Okay. Okay, excellent. So
I
let us
love
go
this
to
other one, not applying for new credit in over 2 years.
Yes. These are all fantastic responses. So you'll hear these themes again as we go forward. So on the next slide, the question now is, have you pulled your credit report lately? So let's talk about this and why is this important. So this is a second seed that I'd like to plant with everyone today. have you pulled your credit report lately? So do you know that if you go to the annualcreditreport.com, you can get your free credit report every 12 months. Now, this particular site is authorized by federal law. So the government is very much behind it. It's a legit site. It is free. So you can receive a free credit report from each of the reporting agencies, the reporting companies out there once every 12 months, or you can request one report a quarter. So what exactly does that mean? So I think we know that there are 3 reporting companies out there. They are called Experian, TransUnion, and Equifax. And between these 3 entities, they collect all of the credit information on every single one of us. So they gather this information from financial institutions. So if you have a credit card, if you've ever taken out a loan, if you have any payments on accounts, even departmental stores, anything, they're collecting all this data on us. If you've ever had any bankruptcies, garnishments, liens, judgments, every single account you've opened, if you have any outstanding balance, if you've co-owned property, if you own property, anything that has to do with money. These 3 entities, Experian, TransUnion, and Equifax, are submitting all this data. They're submitting all this data, on a regular basis. Now, so the reason I'm suggesting that we should pull our credit report, every 12 months, every year from these 3 entities is, because it's important for us to know what is being said about our credit worthiness. So again, this is being placed on these reports. So I should also mention that there are 2 types of inquiries that go on our credit report. Now, there's what we call a soft inquiry, and this occurs when an individual or a company checks your credit report. Now, this type of inquiry usually happens it usually happens without your permission. So soft inquiries happen usually as a part of a background check. So if you're applying for a job, most jobs now do background checks, and when you're pre-approved for a loan or a credit card, so I'm sure a lot of us get those pre-approved letters saying, oh, you've been pre-approved for this card, this credit card, or this loan, just sign on the dotted lines. And also when you're applying for an apartment, a new job, when you're opening up a new bank account, even when you're getting a cell phone account, so a soft inquiry is done, and we're not even aware that this is happening. So now the second type of inquiry that happens is what we call a hard inquiry, and this generally occurs when a financial institution, such as a lender, a credit card issuer, checks our credit report before they make a lending decision. So they commonly will take place when we apply for a loan, a credit card, a mortgage, a student loan, any kind of large loan like that. So, but these types of hard inquiries, we authorize it. So the financial institution will tell us and ask us to sign as part of that decision-making process for that particular request. So hard inquiries can lower your credit score by a few points, and they may remain on the credit report for approximately 2 years, but eventually they will fall off on their own. Now, so another thing we should know is that every lender is different. And so also know that a red flag can be raised, within the financial, with the lender. A red flag can be raised if one applies for several credit accounts in a short time. So if you go to Bank A or Credit Union A, or you take out, different accounts at departmental stores, these are all hard inquiries. So each inquiry, so a potential lender will look at each inquiry as a potential new debt. Whether you got approved for the debt or for that loan or not, the fact that the inquiry is on your credit report is a red flag to a financial institution. And this unknown debt, again, I said you may or may not have been approved, but this unknown debt could make one a greater credit risk and is less likely to have us qualified for a loan. So I should also mention that on this free credit report, there is no credit score. Okay? Now, to get your credit score, you actually have to purchase that directly from one of these entities, these Experian TransUnion that I've mentioned. But now, so, and I'm sure you're wondering, then why would I want to get, this free credit report? So it's important for us to make sure that the information is accurate based on our credit, based on what we think we've borrowed and the loans and everything that's out there. Because you'll be amazed at how sometimes there is misinformation on our credit report. And it is this credit report that financial institutions use to make their credit decisions. So somebody also alluded to it just now, that they have worked with a credit counselor. I think somebody just said that they had sought the help of a counselor in terms of helping them with their dealing with their credit issues. So that's an excellent point, because there are a lot of websites out there that claim to offer free credit reports. So again, suggesting that we should all be careful of them. And also, for what it's worth, there are also a number of sites that will only give you a free credit report if you buy other products or services from them. And other sites will even give you a free credit report and then bill you for services that you will have to cancel. So I'm just making these points that we should be aware of where we go for this kind of help with our, with our credit issues. And again, I am just very high on HomeFree-USA. They're an excellent, excellent partner and have a fantastic track record in performing. So again, to get the free credit report, which is authorized by law, don't forget the annualcreditreport.com. So can we go to the next slide, please?
And just so everybody knows, with HomeFree-USA, and thank you for that plug, Olive, with HomeFree-USA, when you're working with us, since we are a nonprofit organization, we pull a soft hit credit report, as Olive was describing, but we also pull what you call a simulator from Credco, and essentially we pull a tri-merge report, so you're seeing all 3 credit bureaus, and then it is a soft hit, so it's not digging your credit score, and we have a simulator that comes along with it, and with that simulator from Credco, it really shows us and you exactly what needs to be done in order for you to improve your score. So it is a proven strategy, and it's no gimmick behind it, and it has really been seen with our clients to increase your credit score significantly quickly, because you have the experts telling you what to do. It's not just kind of some kind of thought, it's not guesswork. Now, Olive, before we go to the next slide, I do have a quick question that came up. She was saying, they were saying, my lender provides a FICO score every month. However, this score is significantly lower than what I pull from the credit bureaus. Can you explain why this might be, and then we'll move on, because we're kind of running short on time now.
Okay, so I think why this is because so there are 3. We did talk about the 3 credit bureaus, and the way each credit bureau comes up with the FICO score is very different. And and typically on your credit report, so the credit report for this month will talk about the outstanding debt for last month, so it's typically a month behind. So that may be a reason why it's a lot less.
Okay, the month behind. Okay, so it's just basically maybe just slower to catch up.
Yes.
Any of her, and if she paid off anything, or her credit payback pattern. Okay, awesome. And I'll kind of bring in the other questions from there, but go ahead.
Okay, so we're going to move quicker now because we have a lot of materials to get through. So what makes up a credit score? So I'd like to just help you understand what makes up, the scores. So we're looking at the screen now, and I did mention again, there are the 3 credit bureaus: TransUnion, Experian, and Equifax. Now, it is so different lenders use different scoring formulas, and so the score, that credit score, will vary from lender to lender, and and again, these credit scores are used to make decisions on whether we can borrow or not borrow. So usually a higher score makes it easier to qualify for a loan and may result in better interest. So a credit score is also known as a FICO score. FICO, F-I-C-O, stands for the Fair Isaac Corporation, and they are the creators of the FICO score, also known as the credit score, and this is what financial institutions and lenders use. Now, the scores generally range from 300 to 850. The higher the score, the better. So we're going to talk about these percentages. So 35% of the score is based on payment history, 30% on amount owed, 15% on length of credit history, 10 new credit, and 10 on types of credit. So can we go to the next slide, please? So the question now is, one proven way to improve credit is by using a calendar. So is this true or is it false? So if you can just type your responses, and Milan can let us know.
Yes, please type your responses. Let me know if one proven way to improve your credit is by using your calendar. True or false? Are we going to move a little bit quickly? Good. You all are masters. The answer is true.
Okay, very good. Now this is true because as we mark, so a good thing is by marking our calendars, knowing that on a particular day, this particular bill, next slide. Okay, thank you. We'll pause here for a bit. So, marking on the calendar on a particular day, this bill is paid, it helps us to think through and be more deliberate and plan better. And then also, let's all think about signing up for bill pay. And bill pay is usually free with most financial institutions. And again, you can automatically schedule your payments in a timely manner and know that on the 15th of every month, this is the bill that will be paid. You know that, the first 2 weeks, certain bills come in. So would highly recommend either using a calendar or doing the automatic bill pay, or even both if you can. Next slide, please. So the next question
is for me, Olive and everyone on the line, this automatic bill pay has been my lifesaver. My mortgage is automatically debited. I do check my account often and make sure I have enough money in there, but the automatic bill pay is a heaven sent, and it does make a big difference.
Yes, and that's what I use as well, the bill pay. So let's go to the next slide, please. So the question again now is, the question we have
is on-time payment. Does it determine? Oh, go ahead.
On-time payment, does it determine the largest part of your credit score? Is it true or false?
Awesome. We have some experts on the line. Let's reveal the answer.
Okay. So can I move on? So the answer is true. So on-time payment determines the largest part of your credit score. That is very true. So if you remember on one of the previous slides, we have learned that in fact 35% of your credit score is based on your payment history. So 35% of the credit score will tell us whether the payment, again based on credit history. So first, lenders want to know if you've paid past loans on time. So if you pay them on time, and so that's one thing they look at in terms of this 35% score. The second thing they look at is the mix of the credit accounts. So have you paid, because so having a credit card like a Visa, MasterCard, American Express is one type of loan. Then a retail account like from a department store is another type of loan. An installment loan is like regular payments on a car or a mortgage, so these are three different types of loans. So they want to make sure that we have the ability and we pay these on time. And then, so we'll move on to the next slide. Okay, I see that. Okay.
Sorry, I'm scooting ahead a little bit by accident. Okay, we're on 2.
Okay, because I'm not seeing anything on my end. That's why. Okay. Okay, so the question now is, limit the number of credit cards. And so true or false? So do we limit the number of credit cards? So the answer, the response here is, so this is another seed that we'd like to plant, that by limiting the number of credit cards, the fewer credit cards we use, the greater our credit score. Then the next slide after that is, again, we should reduce the credit card balances that we have. So a quick question, and if everyone could respond to this. Balance, so it's a fill in the blank. So the balances should not exceed what percentage of our credit limit? What is the magic number in terms of the balances that should not
Hold on,
exceed?
Olive. I think I may have gotten off a little bit. So we're on number 2, limit the number of credit cards. You know, the fewer credit cards in use, the greater your score. And then have we gone over tip number 3?
Yes, to reduce the credit card balances.
Okay, cool. So now we're at fill in the blank. Okay, I'm caught up.
Okay.
So fill in the blank, everybody, as Olive was saying, balances should not exceed blank % of your credit limit. Great, and look, you all may have already seen some of the answers, but most people are right, Olive, about 30%.
30%, excellent. So let's go to the next slide, please. And this we are going to talk about. So the next measure that the credit card company uses is to see how much we owe in terms of our debts. How much debt do we have that's outstanding? And that percentage is, so 30% of our credit score is based on that one fact. How much do we have outstanding? So owing money on credit cards account doesn't necessarily mean that we're high-risk borrowers. But however, what the bank looks at is the percentage of a person's available credit that's being used. And this will indicate if that person is overextended, and more than likely will they miss a payment or be late. So lenders will look at the amount owned on all accounts. So they'll take all the accounts. So let me give you an example. So, for example, if let's say we borrow $20,000 to buy a car, and we have paid back about $5,000, and we still owe with interest more than 80% of the original loan. The original loan is $20,000. So paying down, so that's a very good example of how we run the numbers. So paying down on installment loans. So I mentioned an example of an installment loan is a car note, is a mortgage installment, because it's the same amount that you're paying every month until you finish paying off that, repaying that debt. And then also note that even if you pay off your credit cards in full each month, the credit report may still show a balance on those cards. And that's because the total balance on your last statement is generally the amount that will show in your credit report. So it's usually a month behind. So also know that in some cases, having a very small balance without missing a payment shows that we've all managed credit responsibly and maybe slightly better than carrying no balance at all. Having a low credit utilization, meaning that the lower the credit balance that we use up, can be better than having a high one or none at all. So for example, closing unused credit accounts that have zero balances, and those balances and those accounts are in good standing, will not raise your FICO score. So lenders also look at how many accounts have balances, because larger accounts with larger amounts of balances can indicate that the consumer is overextended with credit. And then also, we definitely do not want to be maxing out on our credit cards, and because again, this is a clear indication that we are having trouble making our payments.
So Olive, we have a couple questions that came in as it relates to the amount owed. So the question is, basically, if you have a mortgage with more than 30% owed, on your mortgage, would it negatively affect your credit?
No, as long as, okay, so first of all, you definitely have to make those mortgage payments on time, as already agreed to. So it's more the overall package that they will look at. So in that package will also include what are the credit cards and stuff like that. So, and typically an organization like HomeFree will never ever let you get into a mortgage that will potentially make you overextend it. So that won't even be an issue going in. So I think the overextension is more as it relates to the other different kinds of accounts that I talked about. So retail,
So
the
really, when we talk about keeping it to 30% of the balance, it's really to credit cards. I'm just kind of reiterating what you're saying to make sure everybody understands. It's really to credit cards and those kind of credit accounts. With the mortgage, on the other hand, the 30% being owed, or I should say being, of course, people want to pay their mortgage on time, if not early. That is definite. And so really but the mortgage, because it is such a hefty amount, the balance, it being under 30% of the balance, it's kind of it's something that, yeah, would help, but it's going to be hard to do just because it's such a hefty amount, just like a student loan thing. Would it be safe to say you kind of treat those in a different way?
Yes.
Okay. So not to confuse you all, with student loans and mortgages, you're talking about thousands of dollars. So while, yes, it would be great you do want to always work to lower those balances as much as you can, but with large amounts like that, it is, or just with any amount, definitely just focus on paying it on time, because it is going to be hard to just kind of isolate those to 30% of your balance quickly. But so you do want to make sure you pay those on time. The other question is, Olive, so with student loans, it's actually kind of what we just talked about. So with student loans, due to the length of time it takes to pay it off, will this hurt your credit as well?
It'll only hurt your credit if you don't make the payment as required. Whatever that minimum payment is, that is where the credit, that's how it will hurt your credit. So you do have to stay consistent with that. It's not so much about the 30%. It's more about paying it, because that's
35% of the payment history.
Yeah, whatever the number is. Yes. Okay.
Awesome. Okay. So let's move forward. Tip number 4. And you all keep your questions coming in, and I'm just going to deliver them to Olive as they come in.
Okay. So the next slide is number 4. Let's talk about the debt payoff plan. So again, I think at the very beginning, a couple of you said that you had been working to pay off your debt. So I think that's also very good. That's excellent, and that helps to bring down. Remember the amount of credit that we use. That's that impacts our credit score. So pay off small balances first, as you create a debt payoff plan. And by the way, HomeFree-USA can do this for you. So always pay off the small balances first. And so the process that I want to describe now is called the snowballing process, and I'm actually going through it right now personally, and it does work, and it's very refreshing. And so for example, you have debt A and you have a small balance on it, so you pay off that small balance first. And then you take whatever, so let's say that you paid off $100 a month to close out, to pay off that debt. Then you take that payment and add it to the next outstanding debt that you have until it's fully paid off. Then you take the combination of those two amounts that you were paying and add it to the next debt, and that helps move the process very quickly. And and definitely while this is going on, make sure that you pay the minimum payment, at least keep the minimum payment going. So this is what we call snowballing. So that's the snowballing process of paying off our debt. So can I have the next slide, please?
And I gave him the answer. So true or false, I'm on the next slide. It is always best to close credit cards that you are not using. And you all may have peeked at the answer because I exposed it by accident. But it is always best, true or false, to close credit cards that you were not using. All right, everybody got the answer, and that is false. I'll speed to the next slide for you, Olive.
Okay, thank you very much. So that's also a question or a statement. Um, so closing accounts can negatively affect your credit score. So keep the account open. Keep the accounts open even if you have zero balance on them. The next slide is, so the next percentage we want to look at in terms of what makes up our credit score is the length of credit. So that is 15% of the score. So lenders will consider how long a credit account has been opened, the age of the oldest account, the age of the newest account, and then an average age of all the opened accounts. So the longer the account, it says to them, wow, this person knows how to maintain a relationship for such a long time and has done a good job of it. So 15% of the credit score is based on the length of credit. The next slide, please.
So really to get that credit to max out and to get that full 15% in credit score boost, you really need to keep, you need to show long credit history. Thus, that's why keeping those closed accounts open or those unused cards open is a good thing, right?
Or if you've had, so for me in particular, the first credit card that I've ever had, and the only one, was when I was in grad school. So I've kept it open for over 20 years. And so that's an example of, having a long relationship. So the next slide is, so in terms of the credit score, 10% of the score is determined by the amount of new credit, the number of new accounts that we have in our, on our credit report also determines the credit score. So again, would highly recommend that we not go around, don't shop for new credit, and try and work with whatever it is we already have in play because of that longevity that I talked about.
And okay, just to make sure everybody's understanding it, Olive, so you said with the 10% of the new credit, it's not necessarily, and again, I'm just reiterating, it's not necessarily to say that someone should go and open a whole bunch of new credit cards, but is that to say more so that you should just kind of make some purchases just to show that you have the credit, have, I guess, recent credit patterns?
A little bit of that, yes, and making sure, and these are not major credits, credit opportunities I'm talking about now, something minor, and departmental store, get a little bit of that, but make sure you pay it off. So that's 10% of the credit score.
Okay, got you. Okay.
So I'd like to move on because I'm sensitive to the time now, because I want to make sure that there's room for more questions. So the last percentage that makes up our credit score is the type of credit. So 10% of our credit score is based on the type of credit. So lenders, again, will consider the mix of credit. So there should be in our portfolio, in our credit report, credit that, revolving credit. And so this is credit that is automatically renewed as the debt is paid off, and revolving credit cards like departmental stores, right? Departmental stores, so we can call that a revolving credit. They don't necessarily have a fixed number of payments. So with a revolving account, you can pay it off in one day, you can take X numbers of years to pay it off, but as long as you're making that payment, so that's the revolving. And then once you pay it down, that that credit limit still comes back, it's still available. They also look at the, if one has an installmental credit in our mix, and this means that it's a certain number of payments that we have to make for X numbers of years, and this, for example, a car loan or mortgage. Then credit cards, is another type of credit responsibility that lenders like to see. Do we have the ability to make payments on these credit cards on a regular basis? And So in fact, people with no credit cards tend to be viewed as a higher risk than people who have managed their credit responsibly, simply because, again, the financial institutions have no way of determining the credibility and the responsibility of that particular person. So I would like to go to the next slide now, where it states that the fact is that missing a mortgage or an auto payment will ding our credit report more than skipping a credit card payment. So we had talked about that very briefly, that we should always make these large purchases, make payment on the large purchases like our mortgage and our auto payments. I'd like to spend, so the next slide please, which talks about cash is king. I would like to just, again, plant another seed here and wonder, Milan, so how many people on the phone have actually tried the envelope system? Can you just tell
People
Milan?
can type yes or no if you've tried the envelope system, and I'll let Olive explain it. But if you tried it, you'll know, or if you know about it, you'll definitely know what I'm talking about. So if you tried the envelope system for yes or no, so most people, actually everyone that has replied is saying no, Olive. They have not tried the envelope system.
Okay, so I have the pleasure of telling you what that is.
A couple yeses, but most no's.
Okay, so I am moving towards the envelope system now, and why is that? Because cash is king. Now, because one of the things that we talked about is about paying down our debt, right? So how do we pay down our debt? By developing a spending plan, by becoming more focused on how we spend and those kinds of things. So what is the envelope system? So the envelope system literally is working with cash. So I have these envelopes that are set up, right? So we make a determination what in our daily, what spending are we going to use only cash for. So for me in particular, I buy my groceries with only cash. I pay for gas in my car with only cash. Then my own pocket money is only cash. Any allowances I give to my kids, only cash. So there are certain categories in my household that are only cash. So what that means is at the beginning, maybe, every pay period or, again, that's up to each individual to decide, I put X amount of dollars in my envelope for grocery shopping. And I only spend from that envelope for grocery shopping. So let us say I put $200 there for a week, a month. Again, it varies from family to family. And I have $200 for grocery shopping. I will only spend $200 for grocery shopping. If I have for my gas, it's $50 for gas, I will only spend $50. So I will, so for me, it's part of a behavioral change. We had talked about that at the very beginning. It's part of a behavioral change that helps keep me focused on really understanding what, how much money I'm spending on different categories. And in fact, that has helped me to be able to save some money and actually pay down my debt quicker. So, Milan, I know we're at the end of the thing before I turn it over to you, but I just wanted to plant a couple more seeds, if you just bear with me, please, before Okay. So I just want to touch on this issue of co-signing for a loan because it's something that I've heard often. And usually when I ask people...
I'm so happy that you're bringing that up, Olive. I'm really happy you're bringing that up.
Okay. Well, thank you. Because usually when I ask, people, and I do a lot of teaching, is how many of you have co-signed for a loan or been approached to co-sign a loan? It's amazing to see the results, the responses. So I just want to plant this seed that that the request to, so most of us, a lot of us, some of us will sometime in our lifetime be approached to co-sign a loan. So this is a request that we should never, ever take very lightly. And usually when a person needs a co-signer, it is because that person does not meet the requirements to qualify for a loan on their own. But guess what? If you co-sign for a loan, you are legally responsible for that credit, for that loan as well, and it has implications. So when you co-sign for a loan, you are allowing that person, that borrower, to use your good credit to get credit of their own. So once you sign on the dotted lines, once you go to that financial institution, once you tell that person, yes, I will co-sign this loan for you. From that moment, you are legally responsible for the repayment of that loan. So what that means is if that person decides that, hey, I'm not going to pay this loan anymore, I can't be bothered, or whatever the reasons are, then the financial institution will come after you. And that person's loan will also be reflected on your credit report. And so if that person does not pay that loan, you're responsible for it. That will add to your debt load. And remember, all these numbers, these percentages that we're talking about, it does impact it. So any unpaid loan, any loan, once you co-sign for it, will show up on your credit report, including this person, this other person. And so if that other person says, hey, I'm not paying this loan anymore, you also, it could damage your own credit worthiness. And also, I've seen friendships and relationships ruined because of defaults on co-signing for loans. So I'll just stop at that, Milan.
Excellent. No, awesome. Thank you so much, Olive. Let's give Olive a virtual hand clap. Very great information. And I love what you said about co-signing, because so often, you know, when we have people that we love, those that we love may not have as much, have the same financial practices or behaviors or beliefs. And we don't want to put our name on the line, you know, to finance their dreams if we don't even know if they're going to pay the stuff back. So that's a really good point, Olive. Thank you. So as we close out, we heard a lot of good stuff. Please tell me, which strategy do you like best? Which one do you promise to use? Are you going to use the calendar method, which helps you with auto pay and marking things on your calendar, making sure you pay things off on time? Are you going to really look towards that debt reduction, that debt payoff plan? Do you like we didn't even mention part of the tips, the envelope system, but we did talk about it afterwards, which I'm glad that Olive brought up, the envelope system. Which strategy will you use? All the above. Awesome. And these are some very easy tips that can really help you to move forward quickly. So let's work together as we close out. Do know that HomeFree USA is here to provide you with 3 things. We work with you to improve your credit, and do know that credit improvement is just not some thing unto itself. Credit is a reflection in a lot of ways, of course, of your debt, but also how you are spending your money. Where's your money going, or where it's not going, and how that is then showing up on your credit via the debts and your debt payoff patterns. So we're going to work with you to really improve your credit by first working with you to create a feasible but yet effective spending plan, helping you to strategize on the way you're going to pay off debt, helping you to find missing money, helping you to find money that may be outsourced to McDonald's, Macy's, and a lot of other folks, and reapply that to your savings, all in the mission of getting your credit together. Also, we provide you with home buying support to really walk you through the home purchase process. We also provide you with guidance to prevent foreclosure if you currently own your home. So I invite everybody, register, go to HomeFree-USA.org, look at our events page, register for our next event. Lachelle is going to be in touch with everybody to see, you know, to invite you or to move you to your next step. If you're a member of Home Free, she'll provide you with a certificate. If you are new to Home Free, whether you're a homeowner or a home buyer or just a renter who really wants to improve their finances, Lachelle will help you to get to the next stage and step. I appreciate your time. Let's work together to chart your course. We want you to be able to access all the opportunities for financial wealth that exist. And so we're here to really guide you and put you on a path to make that happen. Again, welcome to Home Free USA. Welcome to this session. And as we close out, it's not a goodbye. It's just welcome to a new way of thinking and a new way of changing your behavior so you can change the outcomes, your financial outcomes. I appreciate your time. Lachelle will be in touch with you. Have a great day. And I will put Lachelle's email back on. Have a great day. Thank you so much. And this recording will be on our YouTube channel, so I will put that up as well. Make it a great day.